Hello, ladies and gentlemen. It's Wednesday, Modern Investing with Sasha on IBM TV. And I would like to introduce my esteemed guest, Shaquille Latimer, who is a $1 billion fund manager or former manager or future manager. You you can choose anything what you'd like. Shaquille, what's the right way to address you?
Well, I don't know. I might just be unemployed at the moment. I think, Sasha. I because it's been such a long time. The border's been closed in Australia. It's been such a long time. Been able to go to Europe, and we were made an offer to buy out our management company of the hedge fund in Liechtenstein. So we accepted that offer, and at the moment, I do have another fund in Singapore that we are sort of migrating. We're doing a few things, but at the moment, I'm just enjoying the peace and quiet before
Nice.
it's open.
Okay, and I would like to bring also Nick Polivedes, founder of IBM TV Network. Welcome to the show, Nick. How are you?
Hey, Sasha. How are you doing?
Okay,
I'm
very
doing good.
well.
Had a little bit of a cold, so my voice is out.
Oh,
But other than that, everything's good.
well,
You know,
in our situation, it's not contagious for sure. So it's
that's
great to
true.
have you in any
That's
case.
a good thing about
Uh,
trading stocks is you can't get sick really. You can do it privately, so it's all good.
Sure. Listen, I think we are getting into some turbulent time on stocks. It's getting really frothing. It's There are so many pros that the stock will go higher. Some people believe much higher. At this juncture, there are also a lot of evidence that things are not looking so rosy as they were even months or 2 months ago. What do you think, Nick? Where are we in
Well,
the
where's
market?
Peter Bennett? I wanted to hear his take on this, but my take is I pushed a lot of cash out this weekend over to the market for this reason. Your friend Uncle Joe is going to throw another 1.2 trillion into the kitty, which means there's going to be more money floating around again. Now, I probably brought the wrong stocks, but that's another story. I loaded up on biotech again, only because I don't believe they're going to get this other bill passed. And I thought Bristol Myers Squibb would be a good play. They went down 11% off of fear that they were going to start regulating pharmaceutical drugs. And it did, and I just think it's going to happen. So I bought into BMC. I rebought into Pfizer. Well, I did something really stupid. I dumped it because it was on my list to dump, as I thought, once the pandemic's over. But they came up with a new pill people can take after the pandemic. So I'm going like, oh Lord, are these people who continually innovate? So unfortunately, I had to realize a lot of capital gains and then buy into it at a higher price. But I'm back to a believer of Pfizer for a longer period than I was when I originally bought in about a year ago. And I bought into one of your favorite stocks, the what do they call it, NVIDIA type stock, but not NVIDIA. And the reason why NVIDIA had a run up, I mean, and the P ratios were too high for me, but I bought into another one. I don't even remember what it was, but it was a microchip chip, and it's already done quite well. As a matter of fact, it's almost like an idiot can throw darts and make it in this market, Shaquille. So you and I could do probably quite well in the market today.
Are you calling me an idiot, Nick?
No, I said idiots can do real well in the market today. I mean, I've seen markets like this over 37 years, that the market is a position where almost anybody can win. In other words, it's a game, and they flooded it with cash, so almost anybody can win. The next thing that takes place is the gurus start coming out, hey, and they start charging people fees. I'm going to charge, like I already have it. the Wall Street money machine, the guy named Wade Cook. Go look him up, okay, someday. Wade Cook became Wade Crook and ended up in jail. But bottom line, he ran around to start saying, I'm going to train you how to become a millionaire in the market, and training courses start. So I feel that you're going to start seeing that again, Sasha. I haven't seen it yet because you have to invite people to a seminar, and they charge $3,000 to $6,000 to $30,000. Shaquille, this is a great business. And what you do is
we have that business in Australia. Absolutely.
Oh, they do, and they tell you how you can become rich in the market, and you go through all these training programs. And I'm going like, I just go watch in Modern Investing with Sasha. I'm good. I don't need to training programs.
I'll tell you what my fear is. The Wolf of Wall Street. Look. Fantastic movie. I thought it was very entertaining. But the reality is that, he wasn't a real nice guy, what he did to people. And, we don't want to be seeing perhaps a repeat of that. And I think that, Peter talks a lot about the low yield environment that we're in. And when yields are low and people are used to taking risks, they will all of a sudden start to gamble on even riskier assets. The other thing that I'd be very concerned about is because a lot of people don't really want to be exposed to the markets when it's very tumultuous. Like at the moment today, for example, the US markets have fallen. They've had 8 days of highs. They've fallen now. Some of that's perhaps because of higher inflation numbers. So people start to look at debt instruments, bonds, and things like that. And of course, bonds for good companies are not yielding very well. So what do people do? They say, okay, maybe I should invest in junk bonds. And then somebody makes a couple of good trades. They think they're a genius. And what you end up with is a repeat of Michael Milken, who started selling junk bonds to investors in the 80s. And that, of course, all ended in tears. So that would be my fear, is that the sort of volatility and the tumultuousness of not just the markets, but of politics and how different politicians' decisions are affecting the markets. I think that could cause people to perhaps look for a return in places that are far riskier than a seasoned investor may want to invest their own.
The problem, Shaquille, you can't go to the bond market. I had a meeting Tuesday night. I meet with my team in Salt Lake, and they invest, of course, as you know, in insurance contracts. About $500 million, and all the pressure is down. In other words, by all the insurance companies, even insurance companies basically folding their tent, like Principal Financial Group folded their whole life and annuity division
to invest in AAA rated bonds, right? Because they've got a government guarantee similar to the government guarantee on bank accounts.
Yeah.
But individual investors may find it very alluring to invest in, like in the Wolf of Wall Street, he was getting people to invest in stocks that were on the pink sheets. And when you have a look at Michael Milken's investments, not all of them were necessarily bad, but you have to really understand what you're doing if you're going to invest in junk bonds or bonds in companies that are in default.
Yeah, the thing is, I started out now I guess 37 years ago working with a bond company. It was named Buchanan. You won't hear about it today because it's bankrupt. But let me tell you what the sales pitch was in Fort Myers. Now, I wasn't working for the company. I tagged with this guy to sell my product, which was legal products. It was a living trust, a trust to put your money in. He sold these tax-free municipal bonds that they weren't insured, but the default rate on tax-free bonds were like less than 1%. And no one knew the difference between a government obligation and basically one that isn't. And so what happens, this is Buchanan out of Louisiana. They sold millions of these. Unfortunately, the bonds went bad. And of course, he lost all his clients, but he was in his 70s, so he didn't really care, I guess, back then. And it was just complete cannon fodder. But see, the sales pitch is totally different than the reality. The sales pitch is, these are tax-free bonds. They aren't insured and guaranteed because, quote, that would cost additional funds, which is true back then to get an insurance. So, but the thing is, these don't have a history of default. Go ahead and give me $100,000, put it in your tax-free bonds, and earn this 8% interest tax-free. That stuff goes on all the time as we're sitting here talking, Sasha.
That is an allure. That is the allure to municipal bonds and some state bonds, depending on what state you are in the United States. They are providing you with a tax-free income. You have the feel-good factor of knowing that you're supporting your state.
Right.
The problem is, what do you do? Because unlike a company bond, where you can actually, wind up the company and go after its assets,
Sure.
you can't exactly wind up the local municipality and say, well, we're
Yeah.
gonna sell the roads, or we're gonna sell the local swimming pool. It makes it a lot more
Well,
difficult.
the thing is, the government, the municipality offered the bonds, but did not back the bonds. In other words, what happens is they were not government obligation bonds; they were based on the project bonds. So the security was the project. So you have to go after whatever project they were doing: waterworks, they were doing bridges, toll bridges, whatever. It was a whole big industry in the 70s and 80s when interest rates were high. Then, just like any industry, it sort of collapsed when interest rates went down. And so we didn't see that. Now, in the insurance industry where I operate in, there's these annuity and insurance contracts. Some of them say, oh, you get 8.5%. I see these ads, and it's impossible for them to do that. So how do they do it? Smoke and mirrors. In other words, that may be a first-year rate, a bonus rate, but it's not a long-term level rate. It's impossible because the way the NAIC works, there's no way you can secure those bonds long-term today at 8.5%. So there's still a lot of that stuff going on in the market space. Now, in terms of stocks, what we're looking at, Sasha, I love MPLX. I know we mentioned it to some of our people in another show. Unfortunately, I don't like it. MPLX at the trading price they're at right now, at 31 a share. I like them at 28 a share, So I'm waiting for them to go down, but of course that could be stupid. They may not go down. I bought back into IBM. I bought it once at 120, and now it's back there, and it went up to 135. I ditched it because I thought I like IBM at 120. I don't like it at 135, and so I ditched it. So I'm rebuying it at 120. I don't know if there's anything wrong.
In my opinion, MPLX belongs to a group of high yield stocks that should be probably a core of your investment portfolio.
I agree.
And together with other stocks which I recommend, Altria Group, British American Tobacco, even Pfizer. Pfizer is less attractive because it doesn't pay a good dividend now after it ran from $33 to $48 where it's now. Obviously, it's yield only 3.5% or so. But the gross rates of this company are phenomenal, and I think that stock sooner or later will reflect. So you might as well stay with a relatively low dividend of 3.5%, simply because of the prospects of that unique company in a way. In my opinion, if you have overall return between MPLX and this Altria and other stocks, let's see if you are yielding, say, 7%. You should not do that badly because these stocks, they're not as volatile as high-tech stocks. Even when the market is going down, I notice that the high-paying dividend stocks, they're not going down that much because core of their holdings are institutional investors. And the institutional investors are not really trading the stocks. Let's see, Altria Group, for example, 60% of its shares belong to institutions. Institutions are not going to sell and buy and trade the stocks simply because of its dividend yield. So as long as it's paying 8% or so, close to
I'm totally with you. Right now, Altria is my anchor because I got rid of a lot of MPLX only because I made a lot of money in a very short period of time. And sometimes when I do that, I wish I didn't because that dividend's really healthy. But I did go back into IBM, and I think it's something everybody should take a look at again. Not because it actually went down since I bought it, but the dividend rate is actually over 5% right now, which for if you're looking, see, I'm looking for ones that have good dividends. So if I get stuck in that long-term hold position, I don't care. I got as long as I get a good dividend, but also has potential for growth. I don't think MPLX has really any potential for major growth, but has a great dividend. So that's my only problem with MPLX.
But the reason of buying, let's see, MPLX, for example, is not the appreciation of its price, although that doesn't hurt. It's dividends. That's the reason you're
I
buying.
totally agree. Yeah, it's
Even
my
if I
checking account. Yeah.
However, even if I bought MPLX, I also sold 32 calls against it. So my entry price was lower than it was trading. My entry level price is about $30 a share. So I have no problem if it will go down to, say, $29. I'm not going to sell it. Now, if it will go to 32 or higher, I will have to rewrite calls. So I will buy back 32 calls and I will sell 33 calls, for example.
Yeah.
So I'm trying to get a little bit extra uh, mileage out of the stock through selling covered calls. It's not something what I think. It's just because of my greediness. I don't think it's a good strat. I don't recommend doing that, but I'm doing
Right.
that just simply because I'm a very greedy person. So
Yeah.
I have to
Well,
apologize.
I also agree on the energy. I mean, I'm still holding Enbridge and holding USA compression
Mhm.
partners, and I'm still holding some in MPLX. So it's not like I just abandoned them completely. And I'm holding still in, and I have a lot still in Antrill midstream. Just checking out all this. Kinross finally ran into the positive. It's the hedge, but it's been negative for a long time. Finally, it's gone back up. The hedge finally went up a little bit, and I guess this other trade I did. Oh, it's United Micro Electronics. United Microelectronics is my play on NVIDIA because the PE ratio is much higher on NVIDIA than it is on United Microelectrics technologies. And they basically do the same thing NVIDIA does, except NVIDIA has a dominant position. This company's a lot smaller. In other
So
words, the
this stock,
microchip
I
market.
would call that stock poor man's Nvidia.
It is. You're exactly right. This is a poor man's
Yeah,
NVIDIA. But sometimes these poor man plays have this that NVIDIA doesn't have. That company
sometimes.
can be acquired by NVIDIA at a markup. Okay. And I've done really well when stuff like that happens because NVIDIA searches around and grabs something like that one. NVIDIA, who's going to acquire them? They're too big. In other words, too big to fail, too big to be acquired. But if you look at the performance, man, what a winner that one is.
I'm
And
not sure
I
that
think you might be right. It may be $3 a share.
I'm not sure that I'd say that they're too big to fail, though. We see big companies that are in, say, something like a technology company like that, like these guys are, that do unfortunately, uh, the markets change, and unless they change substantially, you can see that. Something that happened a few years ago that we seem to have moved away from, but it looked like we were sort of going towards, was the idea of software and hardware as a service, where people would have very thin terminals at their end, and they would basically outsource all the processing power and all that sort of stuff into the cloud, where there's a lot more computer power.
Right.
Of course, because you don't need all of that computer power all of the time, the computing power that you need could be scaled up when you need it and then scaled back down, and it could be shared amongst a much bigger group. Much the same as what we saw, 30, 40, 50 years ago, where people had mainframes and thin terminals that they used, but everything was processed by a mainframe. The concern you have with that is really the same concern that you have with the improvement in technology with smartphones and tablets, is that computer sales, have been down for a while. People aren't buying laptops as much anymore. The laptop that I've got, I've had this laptop for almost 3 years now. I spend a fair bit on my laptops, but even still, I normally replace my laptop every year, but I just haven't had the need to.
Right. And that's the problem
Okay.
with any industry. They have cycles, and the only question is what cycle they're going to catch. One thing I have been looking at for a long time is General Electric. And I don't know if everybody saw today, but GE, they plan to split it up. Okay. I'm going to have to go look seriously again. That might be a buying opportunity because the split up may be worth more than the current stock. And that happens quite often when there's a split up among General Electric. Part of the reason I didn't get into General Electric a long time ago, they were involved heavily in building aircraft engines. Okay. During the pandemic, aircraft engines is not a good place to be. So I
Yeah,
just, when I looked, I stayed away from GE.
it's just part of their overall business. However, let's have 1 minute break, and we'll have commercial, and we'll continue right after that. now I'm working on the chess project, and as a part of it, it will involve also cryptocurrency. And to get familiar more with this, I started really to get into phenomena of cryptocurrency, and I started to read a lot and follow certain stocks. And it seems to me that first of all, like before, I was suspicious, but now I'm almost sure that they're definitely chipping at traditional hedges like gold, silver. They are definitely attracting funds from these recognized stores of value. Now they're trying to make a crypto store of value. Now, it still has to be proven. It's still up in the air. But if you take, for example, if you're watching, for example, CNBC, you see how much time they are discussing crypto, whether it's Coinbase, whether it's a crypto itself, like Bitcoin, for example, all kind of new funds and ETFs and so on. So this this sort of ecosystem is keep growing, and it's very difficult to ignore it one way or another. So you definitely have to more or less understand what is going on. I haven't done any moves as investing is concerned. I'm still considering that the preservation of capital should be your primary goal. I still have difficulties to convince myself that it's in that area that preservation of capital is served well by acquiring any stock, whether it's Coinbase or ETFs. And I'm just sort of trying to educate myself. I'm following it. I'm getting into the news, but I'm still not there. What about you, Shaquille?
Look, I really want to like cryptos. I really do, because I love the idea that they're decentralized. They're a little bit outside of mainstream banking. But my concern is that they're just too volatile. And there's so much innovation that to me it's a little bit like tech. I can't, with any sense of sincerity, tell people not to invest in tech. It's just that I don't understand tech very well. And because it's so innovative and because it's so fast changing and such a fast paced area, I tend not to invest, specifically in tech companies individually. If I want tech exposure, I'll get exposure to the NASDAQ, either by buying the index, or now that I don't have a hedge fund anymore, by actually buying ETFs over the NASDAQ or something like that. And maybe I'll create my own index and weight it a little bit more. But, I tend to shy away from tech. And that's really the same reason why I tend to shy away from the cryptos, because it's a young market. I don't really understand it. And a very interesting thing that's happening at the moment is the NFTs, non-fungible tokens. Now,
Yes.
Again, it's something that because people have been asking me a lot about it recently, I've had to try and do a little bit of research to find out what they are, how they work, and that sort of stuff. But it's just so far removed from my area of expertise and experience that I kind of look at it and say, why would I do that? Why go into the unknown if I can already make money somewhere else? And I think that one of the most alluring things about cryptos is the idea. There's a few things, but one is the idea it's decentralized. But the other alluring thing is that it might hold its value better than, say, a fiat currency, which is inflating, which is the US dollar at the moment, the euro, even the Australian dollar is suffering from a little bit of inflation at the moment. But I'm not persuaded that cryptos are really a hedge against that. And if I do want to hedge against that, I think that having exposure to the broad market with some options to counteract bought put options to counteract your downside risk, I think that that's probably a better way of going. But I base it on my own experience because I'm a very adept options trader, so I'd rather do that than go into cryptos. That wouldn't stop me from trying to pinch Nick's coin that he has right there.
So now we are moving into the area of options.
My crypto
By
coin.
the way,
There we go.
yeah,
Isn't it nice? It looks nice at least, right? There we go.
absolutely.
On Bitcoin. Piece of trash.
Now, speaking about options, I would like to mention I'm a big fan of NVIDIA. However, in the last 2 years probably, I never owned a single stock, a single share of NVIDIA stock. I was using options. What I was using a lot is selling put options on NVIDIA. Most of them expired worthless. Um, at one time, though, when it ran much higher, I sold not only put options, I sold also called options, trying to, because the premiums are incredible there. And even I lost some money on call options. I made more than enough on put options, which I sold. So even that trade was positive. However, today at this price is 300 a share, and they split just recently 4-1. So it's old $1,200 a share. And when stock was about 700 before the split, I mentioned that it's $1,000 stock, and nobody would believe me. So, but right now it's already 1,200 on all the
Yeah, if
valuation. So
you
now,
take into account the split, yeah.
yeah, so it's 300, and I believe it will still go to much higher level, probably to 500. And the only thing is, I'm looking for entry to sell puts. I believe that it should go down somewhat, maybe 5, maybe even 10%, but 5 for sure. It should go down a little bit, and then I will sell, of course, a bunch of puts on Nvidia. So I'm waiting for that to happen. Also, I'm thinking about selling bearish spread on probably on S&P altogether. Maybe to buy to sell some puts and cover with lower puts to purchase. So this spread strategy could be quite viable right now, especially if we believe that the market may go down. But I don't expect a big correction of 20%, but say 5%. It's quite possible. So the only thing is, what would be the right time to enter the trade? I'm not so sure right now. I'm still waiting for that. Any predictions from you, Nick, from you, Shaquille?
Well, you're actually going to short the S&P 500?
Yeah, well, it's a bearish short
That's what I'm saying.
trade.
It's bearish.
Yeah, it's a bearish, so I would
Well, I
sell.
mean, usually fourth quarter, which is what we're going into, um, is the best quarter for businesses. The all the data I'm getting is the travel industry is up here in the United States. The death rate is still pretty high, like 1,000 to 2,000 people will die every day of COVID, but we're ignoring it. So if we're ignoring it, then it's not reality anymore to people. So the people are going to be traveling more, which is going to affect the airline industry, the auto industry, the energy industry. At least that's the prediction by AAA. There's going to be more people probably buying things. Consumer confidence is still pretty high. So fourth quarter to me is really the worst time to short. I would like to short, as they say, go in May, then walk away. Now, of course, the beauty of the market, I could be totally wrong. In other words, it's just what I'm looking at. In other words, Sasha, you may have a better window than I do. As a matter of fact, XL Brands, which is my only loser here since, IBM. Okay, and XL Brands. IBM is a loser because I just recently bought it, but I think it's going to go up with a 5% dividend, a lot of growth. But the other one, XL Brands, normally I would dump. It's a dog. But we're going into fourth quarter where people tend to overspend on useless items. And I want to see what their numbers look like the first quarter. So I'm going to hold it well into the first quarter next year, then dump the dog. In other words, there's always got to be a time when you got to dump the dog. You can't hold the dog forever, So XL Brands, I just can't see the market shorting. And then you got Uncle Joe. He's going to push 1.2 trillion more into the economy. The real question is, other than politicians who are going to rake this money, who's going to benefit? 100 million into what broadband? I mean, come on, that's a lot of money. 100 billion, I think it is, something like that. 100 billion or some crazy. We're getting, I think, 100 million, just the state of North Carolina, to blow on broadband projects. come on, Sasha. How can you
Well,
short when they're
So
pumping?
I actually would reach the same conclusion as Nick, but for actually different reasons. Um, and the
A
one thing
concurring
that I
opinion.
would, the one thing that I would actually say is probably, something you've really got to factor into what you're doing at the moment is what Nick's just talked about is fundamental reasons, fundamental analysis, reasons why it would go up. But I don't think this market is working, logically in the way that, somebody who's an adherent to fundamental analysis would be able to make any sense out of. And you have, for the things that Nick's talked about, an extra 1.2 trillion going to the markets, all that sort of stuff. Yes, they might have a buoyant effect, but they might also have a depressant effect, especially if you see, a bigger increases in inflation. And one thing that we also have to factor in is that often liquidity dries up a little bit towards the end of the year as people start to take Christmas holidays and things like that. So to me, as I talk about on other shows, I've talked about relative value. And I would wonder whether some countries, for example, Australia, might outperform the US markets over the next couple of months. And I'll tell you the reason why. Australia has been under some pretty severe lockdowns, much more severe than the United States. In New South Wales, which is the state that Sydney is in, we've had a lockdown here for 3 or 4 months. We've also seen borders shut between various states. Now, although the United States has also been through that, the United States has already been through that for the most part. So they've already seen an uptick in economic activity. Whereas in Australia, we're only just beginning to see that uptick now. And so we're beginning to see very, very high levels of business confidence. I think it might be worth looking at, not just Australia, but looking at a few other countries around Asia and a few other countries around the world, that it's not necessarily that their economies are stronger than the United States, but that they might experience a little bit more growth than the US will, the US will, just over the very, very short term. But either way, I would once again have to repeat myself before, you have to hedge your risk use in some way. And I think that hedging it with options is a very good way of going, because to just take a directional position, and if it goes against you, for example, if you short the S&P 500, if it goes against you, it can go against you into infinity. So I think that you have to have some sort of hedge against, against your position if you are going to try and make any sort of directional play.
Like
Well,
he
this
could
is
have a
this
large
is why
position in the. He could have a large position in the S&P 500 stocks. That's the reason he wants to short some of it.
this is
That would
this is
be a
why I
hedge.
recommend this is why I recommend bearish spread, not just selling or buying put, but actually selling put and buying underlying puts. So this creates a spread which you know exactly what's your downside risk if it goes against you. However, simply because of the time of expiration, and you might, even if the market will be neutral, you may win the trade even if it's not going anywhere, just because of the time expiration factors. So I wouldn't sell long, like a year long position on that spread, but say months and a half. But basically, it's a tactical trade. I don't believe in fundamental trade in this situation, but as a tactical trade, there are some things that I like about that. On Nvidia, same thing, but I really hope the stock will go down just a little bit, maybe from 300 to say 280 would be, for me, that would be an entry point to sell puts. So I'm still
I
waiting
think it
for.
might be an interesting play for you, Sasha, as well, to have a look at the VIX. So for viewers that don't know what the VIX is, that's the volatility index. It has futures and options over it. And what it does is it tracks the volatility of the option series on the S&P 500. And as a general rule, theoretically, VIX for the producers, as a general rule, when the markets go down, big institutional investors can't just sell their stocks. So what they do to hedge off the risk is that they buy options, and that extra buying pressure increases what they call volatility on the option series. So that would be a very interesting play if you think that there could be a sharp downward move because the VIX can be very, very volatile, and the VIX could increase dramatically as a result of that sharp downward movement, if that's what you're predicting.
You see, this is the problem with the entry point, because if indeed market will start going lower, the wick immediately will start going higher. So now, although yes, you will get probably a better premium from the spread, but at the same time, the market is already down. So it's kind of yeah, maybe, you know what, perhaps yes, you will get a better premium on the falling market. So it's very
Well,
difficult to adjust position, really.
to put it in perspective, over the last couple of days, I'm just looking at it now. The VIX has gone up from $15 on the 22nd of October, and at the moment it's at $18. And you can see the last couple of days it's actually moved a fair bit because of that little bit of a decrease. And also as a general hedge. So the VIX often, well, for many years now, the VIX has sat at relatively low levels. But on the 14th of February, 2020, the VIX was at 1368. Then, of course, you saw that huge sort of drop as COVID became a problem, and it jumped from that price to, on the 20th of March, to $66. So those are the sorts of returns that you can see if there's a huge drop. Now, I don't think you or anybody else is suggesting the S&P 500 would drop by that amount, but it wouldn't be unusual to see the VIX, as a result of a market dropping, jump from $18 to $30. And you can see this back in 2018 when the VIX was at its very, very low prices. I actually was trading it around this time. The VIX was trading at around $10, and that was in January. So let's say the 12th of January, it was trading at $10. And on the 9th of February, it was trading at $29, just because there was a little bit of market movement. So I think the VIX is a good tool, especially if you combine it with options and futures, rather than just taking the outright futures position, taking options on it so you can mitigate your risks. I think the VIX is a really good tool because it means that you can have the idea that you think the market's going to drop without having to try to time the market and without having to try to pick the exact entry point. What you're doing is you're just taking that and then hoping for a downward move.
Yeah. Well, yes, timing is everything in this situation, because when you are entering position, I noticed one interesting thing. When you are entering position, in the first 10, 15 minutes, you already know whether you are winning position or you're losing position. It's just almost momentarily you see whether you're in a red or you're in the green, and that's how the trade will go, unfortunately. So that's why when I'm in red, I liquidate position right away. Well, it works well with the idea of preservation of capital. But what you don't want to do is to take too many wrong positions and run for cover. That's why I'm not entering a lot of positions, but I'm rather wait for the opportune time to enter position. So in any case, I wish you a good trading for next week, and hopefully to see you next Wednesday on the Modern Investing Show. Thank you so much, everybody, and see you next week. It's